First, we are going to start with the introduction. What is SME? SME stands for Small and Medium Enterprises, are businesses that operate on smaller scale compared to large corporations. They can be categorized into three main groups: micro enterprises, very small businesses often with fewer than 10 employees. The next one is small enterprises, typically employ 10 to 50 people. And the last one is medium enterprises, which employ 51 to 200 people. They can be classified based on their sales turnover and number of employees, with specific threshold varying by country. For example, in Malaysia, manufacturing SME, the sales turnover must not be over than 50 million ringgit, or they are not more than 200 employees. And for the service SME, the sales turnover must not over than 20 million ringgit, and the employees must not be over than 75 people. Now we move to the importance of SME. The first one is contribution to GDP. SME account for a significant portion of the gross domestic product in many countries. In Malaysia, SME contribute over 38% to the national GDP. The next one is employment generation. SME are major employers, providing job to large percentage of the population, especially in rural and suburban area. The last one is driving innovation and competition. SME often develop innovative solutions to stay competitive and meet customer needs. They stimulate competition, which help improve overall market efficiency.
The first perception of access to financing for SME is financing as a key constraint. A significant majority of SME affirm that they are able to obtain financing. In fact, 97% of SME were able to secure funding successfully. Among these, 27% were first-time borrowers, and 22.6% obtained financing without needing collateral or credit history. Meanwhile, less than 10% of SME report facing issues with financing. Now, for those SME that did face challenges, the primary reason were delay in loan approval, which is SME often lack complete documentation or have limited financial records, which slow down the approval process. Next is request for additional guarantors, which is SME might have insufficient collateral to secure loans, prompting lenders to ask for personal or third-party guarantors. Lastly is higher interest rates, which is SME often face higher risk assessment due to inconsistent cash flow or smaller asset bases, resulting in higher interest rates. Interestingly, the survey found that most of the challenges SME face are not financing related. Let's take a closer look at this concern. Based on the pie chart, the lowest concern is weak business sentiment, which is 28.8%, followed by low sales due to GST, 38.2%. Next, reduced domestic demand, 40.4%. And then, ringgit depreciation, 53.4%. And the highest concern is the high cost of doing business, 63.6%. As you can see, external economic and market factors weigh more heavily on SME than access to financing. Despite these challenges, financing remains an essential enabler for growth. SME benefit in the following ways. First, continued growth in SME financing. Financing to SME has been growing at a rate above 7%, which is higher than the growth rate for financing to household, 5.1%, and large corporates, 6.3%. Next is higher approval rates for SME. The approval rate for financing application from SME is 76.4%, which is notably higher than the 62.3% approval rate for all customers, including households and large corporations. And lastly, increasing share of SME financing. The share of SME financing in total business financing has steadily increased from 38% in 2010 to 49%. In conclusion, while financing is a perceived barrier, the data shows that most SME are able to access the funds they need. Their bigger challenges lie in navigating broader economic and market-related issues. Addressing this non-financing concern is key to helping SME thrive in today's dynamic environment.
Now, we will move to discussion about perception 2, which is a common concern among SMEs regarding the complexity and length of the financing application process. Many small businesses believe the process is too complicated because it is requiring excessive documentation and taking too much time. First, let's explore about the perception and the reality. SME feels that applying for financing involves a burdensome amount of paperwork and unclear steps. This often discourages businesses from seeking loans altogether, even when they need finance to grow. To address this, the Partner Initiative was launched in 2010 to simplify the process for SME. This initiative, it is a standardized loan application form, so businesses have more consistent experience when applying for loans. Additionally, banks introduce checklists to help SMEs know exactly what documents are needed, making it easier to prepare a complete application. So for point number 1, it is about the processing time for unsecured loan that has been significantly reduced. Previously, it could take up to 17 days to approve a loan. Now, it only takes between 7 and 16 days, making it much faster and more accessible. Point number 2, it is about the SME support programs. Many banks have established SME desks to provide personalized assistance. These desks are staffed by trained officers with over 20,000 officers trained to help SMEs navigate the application process. These personalized supports have reduced confusion and improved the overall experience for businesses. So for point number 3, unfortunately, despite this improvement, some challenges remain. One major issue linked to application complexity is the high rejection rate of financing applications. Rejections are often due to incomplete or incorrect documentation and poor financial records. Many SMEs also fail to meet basic financing criteria because they are unfamiliar with the requirements, which reinforce their perception that applying for loan is difficult. By simplifying the process even further and providing better education about financing requirements, banks can help reduce rejection rates and improve SMEs' experience.
Hello everyone, now we will move to the common perception about SMEs, which is perception 3, that banks do not extend financing to startups. There's a belief that banks are unwilling to provide financing to startups due to the risk involved. However, the data tells a different story. Let me explain. First, studies show that around 20% of financing approvals by financial institutions go to newly established SMEs. These are businesses that have been operating for 3 years or less. This demonstrates that banks are indeed willing to support startups. Why is this happening? Financial institutions have become better at assessing the potential of startups and managing the risks associated with them. Additionally, banks now see SMEs, including startups, as strategic drivers for growth. Now, let's talk about rejection rate by SME life cycle. Looking at this graph, we can see the rejection rate for SME financial across different stages of their life cycle. The average rejection rate stands at 20%, but there are slight variations based on the age of the business. Startups or business operating for 0 to 3 years have the highest rejection rate at 21%. This is understandable as newer businesses often have less financial history and higher risk. As businesses mature, their rejection rate decreases. For SMEs in the 4 to the 7 year range, the rate slightly drops to 20%. Between 8 to 10 years, it further declines to 18%. Finally, the lowest rejection rate at 16% is seen among businesses operating for over 10 years, reflecting their stability and established financial management. To conclude, this data shows that while startups face slightly higher challenges in securing financing, the rates improve significantly as businesses grow and establish themselves. This highlights the importance of supporting SMEs, especially in their early stages, to help them overcome these initial barriers. Furthermore, banks are actively financing startups and providing the necessary support support to help them secure loans. In conclusion, the perception that banks do not extend financing to startups is largely a misconception. Banks are not only willing to lend to startups, but they are also taking proactive steps to support and empower them. So, if you are a startup looking for financing, don't hesitate to explore your options. The support is out there. Use it to take your business to the next level.
Now we move to perception 4. I want to talk about something that many small and medium businesses (SME) often worry during tough economic times: the fear of financing being pulled back when they need the most. Let's start with some context. More than 14,000 SME accounts that were struggling financially had to be restructured, and out of those, 73% were active accounts. There is a lot of businesses trying to stay afloat while continuing operations, an impressive testament to their resilience. Now, to help these businesses, about 55% of total restructuring and rebuilding efforts were carried out. This shows a real commitment to support SME, but it also highlights that there is more we could be doing to provide that much needed stability. Here, where it gets interesting. While there is a common belief that financing is often pulled through economic downturns, the data paints a different picture. Less than 2% of SME with existing financial report problems like reduced credit limits or cancelled credit facilities. So, while the fear is very real and understandably, the reality shows that financial support systems are generally holding up. What this tells us is that perception doesn't always match reality. Still, this perception matters because they influence how confident businesses feel about the future. Moving forward, it is so important that we continue to not only provide financial support, but also rebuild trust and reassure SME that help is there when they need the most.
In conclusion, financing is essential for SME growth, but there is often a perception that SME face significant barriers in obtaining aid. In reality, access to financing has improved significantly, with many SMEs successfully securing loan through streamlined process and supportive programs. While challenges like incomplete documentation and weak financial management remain, initiatives like simplified application platform and alternative funding options are bridging the gap. These efforts highlight the growing support for SMEs, ensuring their continued role as key drivers of economic growth and innovation.